Right, so the big story of the day was the surprise announcement by the Reserve Bank of India governor that interest rates, that's the repo rate specifically, will be hiked by 40 basis points. That's not all. They've also increased the CRR, that's the cash reserve ratio, by 50 basis points. Essentially and simply put, it means banks will have to have more liquidity. The reason for this given was that inflation is up and higher than was earlier expected. So now the repo is at 4.40 and the CRR is at 4.5% after all of these announcements. Now the question is this going to be the only shocker for the markets that reacted quite badly to the Reserve Bank of India's surprise announcement? Well, what's really going to come and what will be watched very closely is what the FOMC decides in a few hours from now. So let me begin by going across to my colleague Anisha to put into perspective why that big announcement is awaited.
Well, yes, this policy is coming in the context when the US GDP contracted unexpectedly in the Q1 calendar year 2022, and we have seen the job market which is rather hot or tight in the words of Fed Chair Jerome Powell, and the unemployment rate is near the 50-year lows. Also, don't forget the inflation figure which has reached a 40-year high level and has surpassed the 8% mark. In context of all of this, we got comments coming in from Fed Chair Jerome Powell, who said that a 50 basis point hike in the month of May is not off the table, as well as the fact that they are looking at moving more aggressively with respect to rate hikes because they need to tame inflation. As a result of all of this, the street is already factoring in that there is going to be a 50 basis hike coming as far as the meeting is concerned. And remember, this is the biggest hike that we are expecting since 2000, and this is the first time since 2006 that there will be a consecutive rate hike in two meetings of the Fed. So that's the kind of pressure that the US economy is facing. Separately and more importantly, this time the eyes would be around the balance sheet reduction commentary. The street is expecting that the shrinking of the balance sheet will start in May itself, and there will be a shrinking of around $95 billion per month, $60 billion on account of the Treasury's buyback, as well as $35 billion coming in the sense of mortgage-backed securities. However, the other internals that we need to watch out for is, one, the speed of the rate hikes going forward. Now, the analysts are pegging in that it is one of the most aggressive rate up cycles that we are likely to see since 1980s. There is going to be a rate hike to the tune of 50 basis points in the coming quarters, but whether a 75 basis point hike is likely or not will be important to watch out for. The street also wants to know whether by the end of the year we will be close to the neutral rate of 2.4% or surpass that, and the comments on possible recession, war, inflation, growth and economy will be important to track, because remember, as far as recession is concerned, a Bloomberg survey suggests that there is 44% chance of recession in the coming year. Whether that happens or not would be important to watch out for.
All right, so that's maybe perhaps the big event which spurred on the Reserve Bank of India to hold this emergency monetary policy committee meeting, and then the announcement that we saw. But let's come to exactly what that announcement was. So like we told you, the revised repo rate is now at 4.40, the CRR is at 4.5%, and the reason that the governor gave was that inflation is spiking. Inflation is expected to be higher than what the RBI projected in its April policy announcement. Now, the next policy announcement, the next round of MPC meets was supposed to be in June. So why couldn't the RBI wait till then? And what is going to be the impact of this? We've got a host of voices today on the show, but first, let's listen in to what Governor Das said and responses from industry.
Globally, inflation is rising alarmingly and spreading fast. Geopolitical tensions are ratcheting up inflation to their highest levels in the last 3 to 4 decades in major economies, while moderating external demand. Global crude prices, that is crude oil prices, are ruling above $100 per barrel, and they remain volatile. Global food prices touched a new record in March and have firmed up even further since then. Inflation-sensitive items relevant to India, such as edible oils, are facing shortages due to conflict in Europe and export ban by key producers. The jump in fertilizer prices and other input costs has a direct impact on food prices in India. Further, the normalization of monetary policy in major advanced economies is now expected to gain pace significantly. both in terms of rate increases and unwinding of quantitative easing as well as rollout of quantitative tightening. These developments would have ominous implications for emerging economies including India. Meanwhile, COVID-19 infections and lockdowns in major global production hubs are likely to accentuate global supply chain bottlenecks while depressing growth.
The timing of the rate hike, I'm sure some of you follow me on Twitter. So I've tweeted on Sunday. The wolf of inflation is firmly back. And the future is here and future is now. Obviously, I didn't know what RBI was going to do today, but it was pretty clear that the wolf of inflation is getting more entrenched. And therefore, there was clearly a need to move. I compliment the RBI for having the courage to take this call between policies and during market hours.
Your NIMs have been quite healthy. You mentioned about 4.62%. But with RBI hiking rates now, what is your how do you see NIMs in future, especially after 40 basis hike and CRR hike?
See, I want to actually share with you that our approach, if you look at our NIMs, we have always had high NIMs. And that's because, number one, our mix of retail is higher than wholesale in our total loan book. That helps in getting better NIMs. But these NIMs are high, also reflecting on a significant advantage on cost of funds.
More like a bolt out of the blue, the Reserve Bank of India has set cat amongst the pigeon. First, it was a denial in last two credit policy about inflation and what was happening to the world in terms of how the commodity prices and how things were moving in terms of an uptick. And now there seems to be desperation to simply understand that the red hot inflation, if not controlled now, it could backfire. So Reserve Bank of India, perhaps some would say, has done the obvious, but they've done the obvious in a rather unprecedented manner, which is they've called for an emergency MPC. They've realized that inflation is something which now needs to be tamed, otherwise it could have long-term and medium-term serious consequences, and they've come and rattled the market, I would say so, in terms of a rate hike. Now the bond yields, immediately when the announcement came, remember bond yields were already elevated, they've gone to a new high. Equity markets have tumbled completely down in terms of what is happening to the markets. The net impact, Sensex at the lowest point of the day, Bank Nifty at the lowest point of the day, bond yields at the highest point of the day. Bond yields will always sell off. That means there is nervousness in the bond market. So Reserve Bank of India, in a desperate measure, what was called as a denial earlier now is a sheer desperation to really normalize the economy and control inflation.
So to speak more on this out of the syllabus or out of cycle rate hike which took place after an emergency meeting of the MPC, I'm talking now to D.K. Joshi, Director and Chief Economist at CRISIL, Aditi Nayar, Chief Economist at ICRA, and Niranjan Hiranandani, MD of the Hiranandani Group. Welcome to all of you, and thank you so much for speaking with us this evening on the India Development Debate. Let me go across to you first, Mr. Joshi, with a simple question of, is the RBI today making up for what should have been done perhaps at the last MPC? Is this looking to you more like a preemptive action before the Fed possibly hiking rates?
Well, I think, the situation is very dynamic and evolving, and now I think it has reached a point when inflation risks are very high and they are very broad-based. So it's not fuel alone, it's also core, it's also food now. So a broad-based inflation becomes very difficult for the central bank to not to react to. So that is one aspect of it. The second aspect is that what you just said, I think the Fed is going to be pretty aggressive with their rate hikes, and I think so too. Our external defenses are good compared to 2013, but we are not immune. I think that's what the governor also said. So I think by raising interest rates, I think you also shore up your external defenses. at least the capital outflow that has been happening since October this year, I think that it is basically to ensure that we don't get another shock on that front. So I think it's both these factors, the external financial conditions getting very tight and having an impact on us. I think they have to fight that, and also along with that fight inflation, which is largely supply driven but is very broad based now.
So, Aditi Nayar, what has changed between the last MPC and now? What we're trying to understand is the reason for this sort of emergency meeting and emergency announcement. Is the calculation of how high inflation will be now changing over the last couple of weeks, and that is what the central bank is anticipating?
Tamanna, I think you hit the nail on the head. What really changed after the last, the April MPC meeting is the March CPI inflation print, which went up to as much as 7%, and that was not expected. And now that we have worked sort of our calculations for the CPI inflation for the month of April, our own forecast at ICRA is that we're going to see a print which is as high as 7.4%. So these two prints are definitely something which is much higher than what the MPC or we would have expected around the time of the last MPC review. And I have been, now that it's clear that this is how high the print next week is going to be, I agree with the MPC. There was no point in waiting for another month for the scheduled June policy review to be able to take an action based on what is now clearly on the card, the inflation jump that we're expecting to see for the month of April. So I think this is a very well-timed move. Perhaps in the month of April, there was still somewhat, I would say that the conflict was not expected to be as protracted, and therefore the impact on commodity prices was expected to be somewhat transient. And also, I think the China situation has evolved a lot since then. So while these are all supply side factors, it is something which is imparting a lot of stickiness into our inflation. And I think the MPC took a very good decision to advance their rate hike, which we were anyways expecting to come in the June policy review.
Aditi, if you heard what the governor said, I'm sure you did, but one of the points he made was this rate hike of 40 bips should be looked at as a reversal of what they did in 2020 when they reduced rates because of COVID-19 and to give a boost to the economy. So you're just sort of turning the clock back in that sense. Will that be enough if the primary objective is to control and tame inflation? Inflation is run up more than was expected. Are we going to stop with this 40 bips or is a lot more coming?
So we believe this is step one, and we do expect to see 35 to 60 basis points of rate hikes in the next three policy meetings, which are scheduled in each one of FY23, that's June, August and September. And after that, we do expect to see a pause with a reassessment of the impact of both the war and the rate hikes on the economic growth, and then some more rate hikes after that. So we're looking at a terminal rate of around 5.5% for the repo rate sometime by the middle of the next fiscal year. So this is broadly, this is just step one, and like I said, this is an advancement of what we were anyways expecting in June. Although I would have thought that we would start off with a 25 basis point rate hike, so it's a little bit higher in quantum than what we were penciling in for.
Mr. Hiranandani, let me come to impact. So obviously EMIs will go up for home loans, for auto loans. It becomes more expensive for businesses to borrow. At a time like this, when already there are supply chain constraints and higher input prices, what does this rate hike mean in real terms for business?
Two parts of it. First of all, on the home loan sector, there's going to be some sort of a hesitancy for people because it gives a psychologically negative impact for a home buyer because he believes that the EMI is going up, which it will. But we have to remember that home loans are normally 10, 15, 20 years, and this fluctuating rate becomes an average. So really, we do expect that the home loan rates will again come down maybe a year from today or otherwise. I don't expect this to happen. Number two, I have a slightly differing view in terms of the rate hike, interest rate hike. Most of the items which have caused inflation are import items, food being very small portion of that. and it's possibly driven because oil, Ukraine-Russia war, and the other aspects. So are you going to, by an interest rate hike, actually bring down the cost of these inputs, which is the largest cost of input inflation which is there? So I don't think this input act will really take care of that. But yes, generally, as Mr. Joshi correctly put it, the general impact of it, and Aditya also confirmed that part of it, it encompasses the broad segment inflation which is taking place, and it will only take care of that part. So in reality, this is only a temporary measure. What I would have suggested to the government is really to cut GST rates by at least 10% in order to reduce the inflationary tendency which is in the economy. You have already increased your 1,42,000 crores is the collection. If you gave a 10% rebate to GST for the next couple of months, that would curb inflation completely.
They reportedly, Mr. Hiranandani, they reportedly want to increase the rate. Some states want to increase the rate, especially in the higher bracket, and want to add more items to the 28% bracket.
Yeah, so but I think disaster. No, that will be disaster, because then the $5 trillion economy target of the Prime Minister will certainly not be met. So I differ in the suggestion, recommendation that you, in fact, that 28% should be brought down by 10%, at least as a temporary measure, in order to see that the inflation which is really wrong and happening and affecting everybody across the board will be done. Affordable housing, for example, housing, roads, infrastructure, all that requires a boost, and otherwise how are you going to get employment back? So I think though I agree with the governor on the fact that you do need to do this short-term inputs in terms of interest rate hike as a measure in order to contain inflation, which is the correct move to do, I think, and anyone in his place would do that sensibly. But I don't think that that's the only way to bring the economy back. You strongly need to reduce GST quickly and as a temporary measure if necessary, in order to give this effect to the economy, and only then can you get a boost in the economy, which you really need badly, both in terms of employment as well as a boost in the economy to get it back to that 10% plus that we want to do. This 7.2% is not going to bring back prosperity to India. Already Bangladesh is far ahead per capita income than India, and we will be going down. So while agreeing with the governor on this hike at the moment, I think other measures by the government are needed immediately in order to bring down inflation very quickly, because otherwise it could be a disaster.
So just to follow up there, Mr. Hiranandani, on your sector, on the housing sector, residential real estate specifically, we've already seen prices temper down in some areas. The big boom and spurt we saw post-COVID has eased off. Do you think that this is going to add to the woes of the industry right now?
Tamanna, the reverse is true. Prices have gone up across the board, especially in the affordable sector. It has definitely gone up because cost inputs have gone up more than 10%. Whatever stocks which were unsold before or uncompleted, those are the ones which went at lower prices. All the new stocks are now coming into the market at higher prices. So across the board, you're seeing a 10% increase in prices, both in the affordable and the higher segment market. So the escalation in terms of home prices has already happened, and I don't see that now moving downwards again in the near future under the present circumstances of every input cost having gone up. So you are seeing a hike in prices. It's already happened in 80% of the products. Between 5 and 15%, so an average of 10% has already happened. But having said that, I agree that the measure by the governor is supportive, and I think it's the duty of the governor to see that this excessive inflation which is there should be brought down by this. And there's one more factor which I'm not an expert about, but I still like to comment on it. If the interest rates across the world, including Fed rates, go up, and the inflows which have been negative to India was one of the big factors probably which is also there, which will if interest rates are not brought up, then you're not going to get flows coming into India. So I think that is an issue, but Tamanna, to be honest, I'm not the expert on that. Okay. I would rather
No, my question to you was on your sector, sir, that, are you going to see a further dampening of, is this going to sort of dampen spirits for buyers? That was essentially the question.
Short run, yes,
Okay.
but not in the medium and long term.
Okay.
No.
So, Mr. Joshi, on the point of how much will 40 bips help? If your problem is inflation, if you're expecting 7% plus as the next CPI print as well, what is 40 basis points going to effectively do? Especially when, as you said, inflation is driven, supply side is broad-based, yes, but a lot of it is supply side. There is a limit to how much prices can drop of various products because it's just costing that much to make it. Is this going to be enough, and do we need to see more action now on the side of the central government?
Well, I think I agree that the fiscal authorities will have to complement the RBI's move, as I think Mr. Hiranandani was also pointing out that you probably will need to tweak some more import duties, etc. But I think I wanted to highlight two other dimensions of today's policy rate hike. I mean, one which governor alluded to was the inflation expectations, which are very high, and they are worried that they may get de-anchored. So to control inflation expectations, I think the central bank has to be seen as doing something about it. And I think so this 40 basis point hike will infuse some confidence that central bank is very serious about fighting inflation, and they have surprised actually the market by higher than expected and sooner than expected by most the rate hike. So I think that's one dimension of it. The second dimension is that the January to March inflation is already 6.3%. This quarter is going to be is already predicted by RBI at around 6.3. Now, if the next quarter also is above 6%, then I think RBI also was an explanation to the government why did the inflation go out of control. So there are many factors that led to this decision. How effective it will be, only time will tell. But I would say that you will need some supply side measures also, I think, here.
What could be these measures? The GST cut, like Mr. Hiranandani is proposing?
GST, I think.
Excise duty cuts?
Well, I think I would say maybe there is still some scope for import duty cuts on items which have seen very high price increases, which is one would be petroleum, the other would be the edible oils. I think so. They've already reduced them. Maybe they might have to go further on that. I think so. These are just two examples of that. GST, I would say that GST structure should not be tweaked too much. I mean, because then I think it should not be used as an instrument of bringing the cost down. I think it should be more on the basis of efficiency. I think so. The leeway to do that is with import duties and with excise with duties on petroleum products. I think there is still some scope for them. Although it will mean a trade-off that government will have to lose their revenues. I think which so it creates a fiscal pressure. So it's a balancing act, I mean, that they need to do. If inflation is becoming a bigger problem, then they might have to actually do that.
Just your take, Aditi, on the efficacy of interest rate hikes generally, and of course the 40 basis points interest rate hike in dampening inflation overall, and what could be the next steps? I mean, is this the limitation of what the RBI can do or the central bank can do, and now it's over to the fiscal side for more, immediate measures to contain inflation?
So I want to just make 3 or 4 points. One, as we're all seeing, inflation is well above the 6% upper threshold of the MPC. Second, the number of items that are also displaying an inflation above 6% is now broad-based. So it's not just the fact that there are supply side issues. Of course, that is what has triggered this inflation upswing. But already there is some evidence that the inflationary pressures are getting generalized. And that is something that needs to be sort of clamped down on. And I think that's part of what the MPC tried to do today. And as DK pointed out, re-anchoring of inflationary expectations is very important in this period. Clearly, what was okay for the pandemic era may not be okay and is not okay going forward. So we do need to get out and unwind out of what was done by the RBI and the SEC 2 years back. And this is step one. So going ahead, we do see inflation remaining on the higher side, and therefore we do expect to see more repo rate hikes coming in from the MPCs, and some fiscal measures certainly do seem to be warranted at this point.
What?
Customs duty.
Like what? What kind of fiscal measures?
You won't say I have broken record, Tamanna. I'm always talking about excise duty cuts on your show. So,
no. But I know. It's it's why I'm reiterating again, and I know Aditi you always say this, but look how difficult it is to implement that. The moment you talk about cuts of taxes on petrol and diesel, it turns into a political issue for some reason. कि आपने नहीं किया, हमने किया, and it goes into another tangent. Can we afford to do that right now? We need to act fast as a nation.
Let me put it this way. When we are looking at GST compensation, the transition period of 5 years ending in less than 2 months, I see no chance of GST rates being cut as a measure to cool inflation. I think that's just, it's practically impossible looking at the timing of the GST compensation period coming to an end. I'm not going to get into the political economy question of timing of excise cuts. I'm just going to offer you my own analysis in terms of what we are seeing in terms of the upside for taxes. The revised estimates for FY22 were quite conservative. In hindsight, with the updated information that we have, the growth which is embedded in the FY22 budget estimates is just far too low, considering that we are expecting nominal GDP to grow by about, I would say, at least 13 to 14% in FY22. So we do see a significant amount of upside, and although some of that has to be shared with the state, no doubt about that, but there would still be quite a bit left over to be able to absorb the excise duty cut that I seem to constantly be talking about.
Yeah, so excise duty is one way, GST reduction, if it's feasible and practical, is another way. We can't just keep depending on interest rate hikes, and it's not clear whether that will help beyond a point because dampening consumption demand may not be the ideal situation. It's definitely a wait and watch story. The governor surprised today with his out of sort of the cycle interest rate hike. This won't be the last, and perhaps there are many more to come. Thank you so much to all of you for joining us today.